Financial meltdowns. Marc Faber was just on CNBC last week with a bold call on Greece. Let's listen.
I know what should happen. And what should happen is that Greece exits the Eurozone right away and defaults on all its obligation to foreigners.
Right, joining us on the Fast Line for more Fast Money Portfolio is Mr. Gloom, Boom, and Doom himself, Marc Faber, author of the monthly Gloom, Boom, and Doom report. Mr. Faber, it's great to have you.
Thank you very much for having me.
So what do we think is likely to develop here over the next several days? How messy does it potentially get over in Europe?
Well, I think that what should happen, I just mentioned a week ago, namely that Greece and some other countries should exit the Eurozone. But what will happen is probably that Germany will show more flexibility and that eventually they will issue euro bonds, and so the whole quality of the euro will diminish, and that has already been reflected in the marketplace in the sense that the euro has been very weak. And I happen to think that now the euro is on the oversold side, and that it has the potential to rebound somewhat along with stock markets in the world.
You know, your fellow doomsayer, if you will, Nouriel Roubini, told us a couple of weeks ago that he sees Europe as, in his words, a slow-motion train wreck. Given the news that's starting to develop over there, is the speed of the train wreck in your mind picking up, if you do in fact believe that that would be the case?
Well, I mean, Europe has many problems, but believe me, the U.S. has also many problems. It's not that Europe is an isolated case of a basket of problems, but other countries have the same. And by the way, as an observer of markets, whenever everybody focuses on just one thing, at the present time, Greece and Europe, maybe there are other issues that are far more important, such as a meaningful slowdown in India and in China.
What takes the situation over in Europe to the next more dangerous stage? There's already reports of issues in Spain, regions there, worries about banks. You have the stories about potential bank runs in Greece and perhaps elsewhere. Is that what takes it to the next danger level?
Well, I think the next danger level would be an outright default by Greece or maybe some other countries. I think that would be a danger level. But as I said, maybe it's better to take the loss now. It would have been better to take the losses 3 years ago, and the longer you postpone it, the more likely you will eventually have a gigantic systemic failure.
You know, SocGen was out today saying that a disorderly Greek exit could hit European stocks by 50% or so. For the benefit of our viewers, U.S. traders, U.S. investors, what would the impact to our markets be?
Actually, to tell you the truth, I disagree with that. I think the market would be relieved if finally Greece exited the euro and there would be some clarity. It wouldn't be good for bank shares and insurance companies' shares, but in general, I think the markets in Europe are now very oversold, and on an exit of Greece, I think the markets would rally because that would be some solution. Maybe not the best solution. The best solution would have been never to accept Greece into the Eurozone start with. But it would be some solution, and I think the markets would actually rally.
One of my traders has a question for you, Sir John.
Mark, welcome to the show again. Love to have you. And you're certainly living up to the name, Gloom, Boom, and Doom. And you cited one of the issues as far as the markets perhaps getting oversold around the world. In particular, if there is an exit for Greece, because that roadmap needs to be made, and I believe they're drawing it up right now. If indeed that happens, I agree with you, sir, that we're going to see a decent rally out of both the euro and markets around the world, because it's a recognition of the simple fact that, as you said, they shouldn't have been in the zone in the first place and that these debts are too staggering. Would you think that we are closer and closer, perhaps just days away from that sort of a boom rather than the gloom?
Yes, I mean, I wouldn't call it a boom, because if I look at the marketplace around the world, there are more and more stocks that are breaking down, in particular economic sensitive stocks, and also stocks that cater to the well-to-do people, like Tiffany and so forth. And when this happens, it tells you that the economy is likely to weaken, and that the huge asset price run from which the well-to-do class has benefited is likely to come to an end with some kind of significant asset deflation.
You're not looking for a recession, though, here in the United States, are you?
Well, I think that we could have a global recession sometime, say, starting in the fourth quarter of this year, early 2013. Yes, that's a distinct possibility.
Where would you put it at? If it's on a scale of, say, what, 50% possibility, 1 in 3 chance, where would you rate it?
I would rate it at 100% certainty.
Okay, and where would you want to be invested right now if that would be the case?
Cash, U.S. dollars.
What about gold, Mr. Faber?
What about gold?
I think that investors must own some gold, but as I have maintained for the last 6 months or so, we are still in a correction period, and maybe gold breaks down below the low that we reached on December 29, 2011, which was 1,522. That's a possibility. But sentiment is now quite negative about gold. By the way, sentiment is also very negative about the euro and about equities and so forth. So, as I said, we can have counter-trend rallies, but new highs for markets, that I doubt.
Mr. Faber, it's great having you on the show today. Thanks so much for taking the time to call into the halftime show.
Well, it's my pleasure. Thank you very much.
We'll talk to you again soon. Marc Faber. Later on, of course, we're going to trade the euro with Jens Nordvig, global head of G10 FX strategy at Nomura, who's making a bold call on that currency. So you'll want to stay tuned, certainly, for that. Steve Weiss, reaction to Faber?
Well, I agree with him that people aren't focused on China and India, and they are slowing dramatically. I do think China is closer to a hard landing than a soft landing. We saw that their bank lending has slowed markedly. In terms of Greek, the way I look at a Greek exit is like the U.S. credit downgrade that we saw by S&P, that will be a reason for the market to move higher, except you need other steps by Europe to ring fence Spain and Portugal, unless they let Portugal go too, which I don't think. What I'm looking for near term is the ECB coming out and ensuring deposits in the banks to stop the outflow of capital. The U.S. did it. I think that's the next thing the ECB will